So, can you define options trading for anyone who hasn't played, I say, that game before? What exactly is options trading?
So, options trading is a way of trading on the stock market. We only trade on the US stock market, but we have people that are students all across the world. So, I think there's like 20 something countries now represented in our program. So, you can live in New Zealand or Australia and still trade on the US stock market, right? There's international trading brokerage accounts. The difference really between options and stocks is, quite frankly, in the name options, right? The name options, it actually means you have different choices. You have different ways that you can trade that you just don't have those same choices when you trade stock. And one of the things that is principal about options is the ability to leverage and create a larger income with less risk if they're used appropriately, right? And to really kind of explain it, like, believe it or not, options have been around since 340 BC. They've been there for that long. The first options trade was by this astronomer and philosopher, a Greek philosopher by the name of Thales, which, funny enough, is my son's name. And I didn't name my son after, my son was named after him, but I didn't know that at the time that he was an options trader. It was really kind of funny. But so yeah, he's the seed story of options. And what he did is he was an astronomer and he could kind of predict the weather patterns based on astronomy. And so he said he knew that there was going to be a good olive crop coming in the next year, in the next season. And he wanted to be able to really be highly successful with that on a transactional basis, right? He wanted to go out there and create a bunch of olive oil. But the problem is there's only so many olive presses in the region, the factories that could press the olives and make olive oil. And there was a lot of competitors and they would fill up and he wouldn't be able to get enough to really make it make sense. And so he had this thought and he said, I know it's going to be a great season next season. I know it's going to be a great crop. And I don't think most people know that. So I want to leverage that knowledge. And so what he did is he went to all of the olive press, people in the area. And he said, look, I want to make you an offer you can't refuse. We'll mix some mafia with it a little bit. And he said, look, you don't know if it's going to be a good crop next year. It's a toss-up. The weather may go against us when we have a bunch of storms. You may have almost no business for your olive presses next year if the weather's bad. What I'd like to do is I'd like to pay you a small amount of money today, and you'll get to keep that money regardless of whether it's, a good crop or a bad crop. You get to keep that little deposit, right? And all I ask is that you give me the option of getting exclusive use of your olive presses in the upcoming season. Now, for me to exercise that option, I'm going to have to pay the full market price. So you're still going to get the full market price for your services, in the spring, but I'm going to pay you a reservation fee essentially now. And if the market goes bad, you get to keep that money. So it was a no-lose proposition for them because they would get their full billing rate in the spring regardless, but they got to get some money up front, right? And that was a little bit of a hedge for them, right? Because if the weather went bad and they were not going to have any business that next season, they would still at least have the income from that hedge that they made with the deal. And so it was a great deal for everybody. It was a great deal for him because if the weather went well, he could lock up all of the olive presses in the entire region and he would have exclusive use of all of them. So he would be able to massively cash in on his crop and profit from that and eliminate his competition at the same time, right? Like it was a huge win for him. And he had to put up some money up front. So there's a little fee that he had to pay up front. And he's risking that. He's saying, I'm willing to risk that small fee. That is the definition of a call option. A call option is for something to go up, to go positive, right? So that he was betting on good weather, right? And he was willing to pay a small fee for that to lock in that option. And so an option is really just a contract that has an expiration date in the future. and it has a particular value associated with it, and that's really it. The difference that this makes for traders is because now the contract itself, not the stock, but the contract itself has value, right? So imagine now Thales did go on and have a great production and made a bunch of money off of that contract, okay? But let's flip it for a minute. Let's say that a month after he paid all of this money and he bought all of these options, right, to have access to the olive presses. Let's say that he changed his mind. Well, he could sell that contractual obligation that he had, that contract, he could sell it to somebody else and make profit on it, even without having ever produced a single olive. Right? The contract itself has value, right? You can think of this as like, think of a real estate agent that has some friends that live on the coast that are contemplating selling their house, right? Now, he's not an agent, he's not a broker, but he has the contact, he has the access, and so maybe he sells a contract to negotiate the deal, even though he's not a broker, and then he just pays a broker a brokerage fee to close the deal. But without him, you don't get it, right? So he has that control. This is what options are all about. Options trading is about leveraging access to a block of 100 shares of stock and being able to do that in a very intelligent way. Now, most people, when the very time they hear the word options, they think high risk and you lose a lot of money with options. They've heard a lot of negative stuff in it because it's highly regulated in the industry. There's all kinds of people that have lost a ton of money on options. The problem is they don't understand that with any contract, there's a buyer and a seller, right? And the people that are buying those contracts, everything is at risk, right? Just like Thales and buying those olive press contracts, right? If the weather goes bad, he loses everything. He loses all the money that he paid. It's gone. And he's not going to have any olive oil to produce, so he's not going to have any profit, right? So he loses everything. Well, when you buy options, that's the problem. You have to be right on the price direction. So if you're buying a call option on Tesla at, 280 or something, then you're essentially, saying, I believe Tesla's going to go up to 280. Well, if it goes down, you lose everything on a call option. If it even goes sideways, you lose everything. Even if it goes up, but it goes up after the end of the contract, you lose everything. It doesn't matter because you're not just buying the direction, but you're buying it in a specific time frame, right? And so it's buying call options or buying put options, either way, it's really risky. And about 70% of consumers that trade options in this manner lose everything on it, right? It's very difficult. You have to be correct on the direction, you have to be correct on the time frame, and you have to be correct on how big the move is. So let's say that I get the direction right, it goes up. I got the price point right. I said it was going to go to 280, it's 282. And I got the time frame right. It did it before my expiration. I'm a winner, right? No, because you had to pay money for that contract. And let's say you paid $500 for that contract. Well, if it doesn't go to 285, if it doesn't go up high enough that you make that cost of your contract back too, then you still lose, right? You may not lose everything, but you're still going to lose some money. So buying options is highly speculative. And it's very, very risky. And you must be right on these three things: price, directionality, and magnitude, right? But selling options, super, super conservative. Just the opposite. When we sell an option, we get paid our premium upfront. So the day that we sell, we sell weekly options. So we sell on a Monday. And we get paid right then, okay? And so we've got our cash back. But we still have the contract tied up for the week, right? So let's say it's a $10 stock. We put up $1,000 for the week, okay, for that option, and we make maybe $20 on that transaction. Doesn't sound like much. You think, well, Troy, that's only $20. But $20 divided by 1,000, that's 2%. and you made that 2% on your money in a single week. This is the magic of what we do. We have a framework that I've developed and created after doing tens and tens of thousands of trades. At this point, I've lost track. Last time I checked, it was over 25,000. I think at this point, it's probably over 30,000 trades that I've done. I trade 24 different accounts because I have multiple businesses. I got a whole lot of kids that I trade options for, and we'll talk about that in a second too, which is really unique. So I do a lot of volume with it. And in that time, it only takes me about 2 hours a week to do the trading. And for that, I have a 98% plus win rate. And I make that 1% or so every single week on the money. But when you think about that, this is why not many people trade options in this way. Most people go for the buying options because that's where they think all the big money is, but it's really just the opposite. It's where all the risk is, right? But when you sell those options, that 1%, that compounds weekly. And if you compound 1% a week for a year, that's not 52%. That's like 68% when you compound it, right? So you're looking at a way where you can only spend a couple hours a week. As an entrepreneur, you've got other things going on. As a coach, you've got your coaching business and everything else going, right? And you can win at a very high win rate. Very rarely do you ever lose unless a company goes out of business. And it only takes a little bit of your time. And yet you're able to pull in, returns that potentially can 3 or 4x what the typical market returns are. And that's what we developed. That's what I created. And that's what I teach in low stress options. It's really a combination of doing that and then bringing that to the entrepreneurial world, which is where the real kind of creativity comes in. If you'd like to learn more about the low stress options framework, then please join me on a live call. You can go to getlso.com to register now.